if you get the reverse of that in the next 1, 2, 3, 4, 5 years, you're going to see that PE multiples shrink, even though there's going to be earnings because of all that money printed. So you're going to have particularly the commodity sector and the industrial sector do very well. I'm predicting gold go to 20,000 by the early next decade. Silver go to probably 500. Oil go to 500 a barrel. So you're going to have sectors that are going to be doing very well. But look at all the growth sectors that have done well this cycle. They aren't going to be the winners next cycle.
With inflation projections around 2.5%, gold's role as an inflation hedge remains strong. Any inflation that exceeds expectations could spur even greater demand for gold. Gold has traditionally served as an inflation hedge during periods of rising prices, with historical data showing an approximately 80% correlation between inflation surprises and gold price movements in the subsequent trading week. Prominent investor DavidHunter predicts inflation will surge to 10% within 2 to 3 years and reach 25% by the early 2030s after a deflationary bust. He sees commodities leading, with gold at $20,000, while silver and oil are at $500. In the short term, Hunter expects gold to reach $4,000 by year-end, following a sharp rally and brief consolidation. According to him, silver could potentially reach $75 per ounce by 2025, driven by increasing investor interest. Historical analysis reveals that gold typically appreciates 12 to 18% during the first 6 months of major trade disputes, outperforming most traditional investment vehicles during these periods. This pattern remains true in the current market environment. While discussing the downfall, DavidHunter warns that in the post-bubble bust, most assets could crash. He expects silver to fall by up to 70%, while gold may correct by 40 to 50%, retesting the $2,000 level. Over the past 18 months, several powerful forces have driven the precious metal to record highs. Inflation remains high. The U.S. national debt has surged past $40 trillion, and geopolitical risks continue to escalate across multiple regions, including Eastern Europe, Taiwan, and the Middle East. Based on major fundamentals, Hunter warns that global leverage now exceeds 2008 levels, with $330 trillion in debt and massive derivatives exposure. He predicts that during a severe deflationary bust, the Fed's balance sheet could reach $30 trillion by 2026. Concurrently, Hunter believes this cycle's market top, potentially 8,700 on the S&P 500, will not be revisited for decades. Before we dive into DavidHunter's sharp insights from his latest interview, make sure to hit that subscribe button and tap the bell icon so you never miss a moment when truth meets the market. Let's get into it.
Going into the top, I'm calling for gold to go to 4,000. We rose from 2,500 in 9 months, I think. Maybe it was less than that. We went from 2,500 to 3,500, so rose 1,000 points. And then we've spent the last 3 months consolidating that gain. I think you're very close to a liftoff in gold again that could take it to 4,000 in that same sprint, but certainly this year. Gold might go beyond the stock market top because the top can build for a few months. So I'm saying you probably see 4,000 gold by the end of this year. Silver, same story. It took a long time to get going, but silver just today, I think, is at a 14-year high. It surpassed highs in 2011. Not the high of 2011, but that was the last time it was at this level. So I think silver is getting going, and as I said, I think it can go to 75 this year. Then in the bust, I think almost all assets other than treasuries get hit. And I think, silver is a much more cyclical metal than is gold. So I'm thinking that'll be more volatile to the downside. So you could even see silver, if the stock market's down 80%, silver might be down 70%. Who knows? But from 75 to 70, down 70% is, what is that? Probably 2,200. So, 2,200. So it's not down at 500 or 1,000 or anything, and gold probably doesn't lose more than 50%, maybe 40%, who knows? Because it's more of a run to safety metal. People do use it for some defense purposes, but if you go to 4,000 and you correct 50%, you're back to 2,000, right? So, and that would make sense or close to that, because that was the breakout. We broke above 2100, and then that was where we took off. So I could see that. Guess what? We're here in 2025. Leverage is way beyond 2008 and 9. Both in terms of debt, which is 330 trillion in global debt, and in terms of derivatives, which are quadrillions in notional value of derivatives. So as I say, debt is the leverage on the economy, on the financial system, and derivatives are the leverage on the markets. And so I think, given that we're moving to this extreme where it's taken so much money to get us out of the hole, I think we're at that point where, if I'm right, that we're not only going to have a recession, but a global bust, which I define as bigger than 2008-9. And we have central banks, particularly Powell, but particularly the Fed, but central banks around the world saying, we don't want to repeat the mistakes of this last decade. We do not want to go back to ZIRP policy. And that's why people think he's just being political. I think it's more he's fighting the last war. He's saying, we got so criticized as an institution in terms of, keeping rates at zero for so long and creating the opposite problem, that this day he's already promised us he's not going back to it. He's not going to be the Fed put, going back to this huge QE. So in his mind, that's done. That policy's gone. The problem is, that's easy to say until you see something staring in your face, that the only thing you have is money. And that's what I believe is coming, is that we will have a global bust, meaning bank failures dominoing across the world. And the central banks will have no choice, because there's nothing else that can move quick enough to save that. They'll have no choice but to print money. And they'll start, as I say, the Fed will probably start in response to a recession. They'll say, well, we have to ease here. We're letting up on the brakes on money. We've lowered rates. We started to lower rates, but we also have to start doing some QE. But we're not going to do what we did before. So we'll do maybe $1 trillion. And we're not going to do $5 trillion. And then they look in another month, and it didn't do any good. Things are still falling. And so several times they'll go to, now we're going to do a couple trillion more, but we're not going to 5. It'll take them probably 8 or 10 months to get to a right-sized policy. In the meantime, things are falling apart. And again, I'm using the U.S. as an example, but it's around the world. And by the time they realize we can't worry about what it's going to do down the road, we gotta save the system, you'll have put 20 trillion in. So you could see a $30 trillion Fed balance sheet by, say, 2027, maybe 2026. And of course, and I think that global bust is going to be a deflationary bust, because we're going so far down here. We're not far from, if you listen to Trueflation, we're not far from 1% now. So you get a bust, you're surely going to be in negative inflation. So if you're in negative inflation, that money that's being printed all around the world, 20 trillion here and likewise elsewhere, is going to take a couple years to really show up as big inflation. Your first year out, you might be back into positive territory of a couple percent. The second year, you might be moving up pretty quickly and being, above 6%, maybe on the way to double digits. By the third year into the recovery, you're well past 10% and on your way to 20. And I estimate by the early 2030s, we could be looking at 25% inflation in this country. So if you're going from negative inflation to, let's say, 10% within 2 to 3 years, and to 20 or 25% within 5 years, what's that going to do to PE multiples? From 1982, the reason I say this, a 43-year secular bull market, is 1982 was the start of the disinflationary trend, where PE multiples expanded from single digits to all the way up to now 23 times. If you get the reverse of that, and that all that time we ratcheted inflation down from 20% to 1% so far on the way to negative. If you get the reverse of that in the next 1, 2, 3, 4, 5 years, you're going to see that PE multiples shrink, even though there's going to be earnings because of all that money printed. So you're going to have particularly the commodity sector and the industrial sector do very well. I'm predicting gold go to 20,000 by the early next decade, silver go to probably 500, oil go to 500 a barrel. So you're going to have sectors that are going to be doing very well. But look at all the growth sectors that have done well this cycle. They aren't going to be the winners next cycle because you're going to have interest rates go with inflation from zero. I think the 10-year will get to zero in the bust, go from zero to almost 20%. And if you have that, your multiples are going the opposite direction. So even if you have earnings, it's going to be capitalized at ever higher rates, and therefore your P multiples shrink. That's why I think we're at the all-time peak. I don't think the peak this cycle, wherever it is, I'm saying 8,700 on the S&P, maybe I'm still too low. I don't know. I think it's pretty high. But I think going forward the next couple decades, you're not going to come close to that number. Whatever the number is this cycle, you might get coming out of a bottom. If you get an 80% bear market, as I'm calling for, coming out of that bottom, you could have a triple or a quadruple off that bottom and still be far from the 8,000 or 9,000 on the S&P.
In the interview, DavidHunter mentions that institutional investors remain cautious despite substantial market gains. He views a soft landing narrative, falling interest rates, and earnings resilience driving markets higher into a final secular top. He believes the Fed's massive quantitative easing will not occur until after a 2026 global economic downturn. For some time, market participants have anticipated that the Fed will halt quantitative tightening this year. However, earlier in 2025, the Fed slowed QT to mitigate the risk of market disruptions, while the Treasury Department took action to address government financing needs amid wrangling over the government's official borrowing limit and its broader budget requirements. Much of that uncertainty was resolved last week with the passage of a Trump administration budget bill that lifted the borrowing cap, allowing the Treasury to sell more debt. Increased debt sales will reduce the reserve levels the Fed has been trying to shrink through quantitative tightening. In his outlook, Hunter believes the bond rally is driven more by institutional investors extending duration than foreign buying. He sees confidence rising as rates peak and the economy slows without tipping into recession. Let's get back to the interview.
I think surprisingly, we're still in a situation, in spite of the fact that we had the S&P run 40% plus off the bottom and NASDAQ more than that, in spite of a lot of new highs, you still have basically institutional investors very cautious and skeptical of this market. Yes, you're seeing some targets raised on Wall Street, but generally, I think institutional investors have one foot out the door. So I think until they're all in, this thing has legs, and final leg, not to mix up terms, but right. Retail surprisingly didn't panic at the bottom and stayed, at least a good chunk of retail stayed bullish and has remained bullish here. And there, it's kind of a divergence here that's surprising because usually everybody calls the institutions the smart money and the retail kind of the dumb money, but it's been in reverse here for the last couple months. And I do think that it is, from a sentiment standpoint, there is still a very big wall of worry that provides the fuel for the advance into the top. In terms of fundamentals, I think the narrative is going to be soft landing, no recession in sight, rates coming down. That's a bit contrary here, but I do think you're going to see a big drop in rates. And I think ultimately the Fed will join the party, whether it's in July or September. I think we're going to see a rate cut one way or the other. As I've said many times, rates are coming down without the Fed. So I'm not so caught up in trying to worry about whether the Fed's going to cut in July or September or whenever, because I think the bond market is already starting to take rates down. They were 460 not long ago, and we're down to 440. They were down almost 430 yesterday, I think. So we're on our way down. I expect over the next probably 3 or 4 months that you could get down well into the threes, almost to 3% probably by fall. And that will be certainly an added tailwind for the market. I also think as we move through the summer and into the fall, we're going to see more and more of certainly Wall Street buying into the Trump policies and realizing that, yes, we are, tariffs aren't going to destroy things. we aren't going to see a big rise in inflation. The economy is actually slowing, so rates can come down. Inflation's still trending down, et cetera. I think the recognition of how much deregulation is going to help offset the tariffs, how much the drop in oil prices is going to help offset any inflation fears, et cetera. I think that's all going to come together here in the next couple of months to help drive this thing higher. And and at the same time, I think earnings are going to be still looking very good. So, not gangbusters, but intact, meaning, you'll have some growth in earnings this quarter, and nobody's going to be worrying that it's the end of the earnings cycle. I think there'll be some stimulation from rates dropping, but in terms of money, I don't think see the big money surge into the system until after the top. So I'm not counting on a lot. The Fed is not a big piece of my rationale for why we're going to into a parabolic run here. Mm-hmm. I think the big money print that I have talked about with you and for a long time, that could be to the tune of $20 trillion in expanded QE just out of the Fed, with proportionally like expansion elsewhere around the world, everywhere around the world. That comes in response to what I think is a global bust that is coming, but is just being put off until we'll go through the beginning of the recession, and then I think that morphs into a bust because of the leverage in the system. So I think both of those things are more or less 2026 stories. You could see recession, in coming months here this year, but it'll be mild enough that it won't push investors away. I don't think it's so much foreign buying, which would be more dollar related. I think it's institutions, primarily institutions, starting to go longer out on the yield curve, stretch in duration, feeling more confident that rates have peaked and are rolling over. It ironically will probably be more about the economy slowing, not expanding. But at the same time the economy is expanding, some of those early cycle things like autos and housing will be starting to go the other way because of rates. And it'll give confidence that, hey, yes, we're slowing, but we're not going into recession. Or, this is kind of that rosy scenario we used to talk about years ago. It's you get your cake and eat it too. You got rates coming down, economies growing, but not growing fast enough to push inflation up. I think if you look at why are so many, when you hear the bears come out and talk, what do they focus on? They focus on inflation going up, that it's, we've bottomed out and we're heading back higher. Tariffs are going to be part of that. They focus on the Fed and that the Fed's got no reason to ease for a long while yet. I think all those things will change in the next couple of months. And ironically, it will probably be because of a slowing economy. I do think tariffs are going to have some impact on consumers. They have to. I mean, we saw a lot of buying ahead of the tariffs. It's stolen some of the growth from the future, and the economy is already slowing down anyway. So I've even said, when we go back and date the recession, it won't surprise me if we find we've already started in one. Certainly factory orders and ISM indexes and things are in recession. The consumers held together, but we're even hearing talk about the high-end consumer, who's really been the buyer, starting to show signs of slowing. So I wouldn't be surprised if we get into recession by sometime this summer, but I don't think we'll know that for a while.
The road ahead for gold in 2025 is marked by uncertainty. Global events, economic changes, and policy shifts could push prices in either direction. HSBC expects gold prices to remain stable and continue to strengthen in 2025. Given the current commodity outlook, do you think gold will continue to shine as a reliable hedge against inflation and market volatility? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the following video.